But what I wanted to talk about today, because I think one of the reasons that a lot of you are here is because we are kind of licking our wounds a little bit from yesterday's massive volatility spike. So we're going to put that in a little bit of context historically, and then I'm going to talk about a few baseline signals that you could overlay that might help you avoid a few of those in the future. Not all of them, and we will get to that. You can't avoid them all. But first of all, let's just check out what we're actually talking about. So yesterday, of course, February 25th, 2021, there was a very large VIX index spike. So you can see it down here. It actually ranked number 23 on the all-time list. Obviously not the biggest. That will still and hopefully always be reserved for February 5th, 2018. But, a 35.38% spike, that is no picnic, especially for people who have a short vol, long equities bias. That kind of came out of nowhere, and it was a big spike. It was uncomfortable. Now, for us, for anybody who's following my stream, we are more specific to volatility ETPs. So we can actually look at the damage that was done to the VXX. Now remember, the VXX is a long volatility instrument. It's a long volatility ETP. So whenever volatility spikes like that, the VXX is going to be going upwards. And you can see it again down here. It's highlighted in blue for us. This is the second one this year. It was up 15.95% yesterday. Single day spike, nearly 16%. Now the S&P 500 was down 2.45. I would say that's sort of on the low end whenever you see, if you just scroll through some of these numbers, you can see that the S&P can sometimes be extremely high when it spikes volatility, and other times it really doesn't take very much to spike volatility. Here's one on June 13th, 2016 at the bottom. The S&P was only down 0.81%, but the VXX didn't like what it saw, and the VIX futures market, of course, went a little crazy that day. So anyway, we are faced with February 25th, obviously quite big. Those don't come around very often. The VXX launched in early 2009, January 29th, 2009. And so, yeah, very uncomfortable day for probably most of us. Like I said, it was a difficult one to see coming, as we will get into. But if you scroll through these numbers, what you may notice, and a lot of people were pointing this out and commenting on my Twitter account when I posted this chart, that quite a few of these are actually from 2018 and beyond. Now, if you scroll through that list, you can see that 15 of them are actually from January 2018 and later. So half of the largest volatility spikes, and again, this is going back using simulated prices all the way to March 2004, in the last, 17, 18 years, half of the occurrences of big VXX spikes are just in the last 3 years. Now, you might be asking, well, what does this do to the short vol trade? Well, this is one of the metrics that I use, one of our primary core metrics. It's called the volatility barometer, and it's clearly showing that there has been a volatility regime change since that date. So the dividing line right there, my barometer only goes back to 2011. Some of the metrics that I use within this barometer, they're not entirely accurate going back further than that. Some of the metrics existed, some of them didn't. So it's more robust if I start then. But you can clearly see that the long-term average went from about 40%, which is a nice, comfortable, sort of, in air quotes, short volatility range that everybody would be looking for. And now, in the last 3 years, this line is February 5th, 2018, we are averaging about 60%. Now, a 20% increase, again, it may not sound like a whole lot, but trust me, the way that the barometer is calculated using percentile rankings, a 20% average higher reading is very significant. So there's no question there has been a major volatility regime change just in that time. Now, just a side note in case you wanted a little bit further information, if you go to the YouTube channel, there is actually a video on the volatility barometer. I don't share, of course, the exact way that I construct it, but you can get a very good understanding of what I'm doing. Essentially, I'm taking a whole bunch of volatility metrics from my daily emails. This is the daily email from today. You can see there were quite a few trades moving to safety. But all of these metrics and many more combined into what I call the volatility barometer. Now, again, today, of course, a reading of 73.6, that's very high. But pre-2018, we were looking at about 40%. Post-2018, almost 60%, which is a major, major difference. Now, what has that done to the actual short vol trade? This chart is showing a short VXX position constantly held and daily rebalanced. Now, the reason that you would want a daily rebalance, just in case I know in the comments people will ask me why we do that, is because, as we know, volatility ETPs have declined insane amounts since they launched. And whenever you're short something, the best case scenario, if it actually goes to zero, you can only make 100% on your money. So if you started all the way back here, it's over 100,000, and you shorted it and just held it the entire time, best case scenario, you can make 100% return. But it's gone from 102,000 to $17. So obviously you would want to daily rebalance so you can capture what was, at least before 2018, a several thousand% return if you were to short this thing. But as we can see on that recent chart, since January 2018, not only is it not making the thousands of percent over that 10-year period before, but it's actually way, way negative these days. The short vol trade, for all intents and purposes, is basically broken. For people who are trying to short vol and trying to do it somewhat blindly, it's basically broken. You definitely have to be tactical with your entries and exits. You have to manage your position sizing extremely well, because there's no question that this is not what the chart looked like from, say, 2010 up until 2018. I'll do a live stream next time, maybe in a couple of weeks, showing all of the data and the comparisons between them. But trust me, it looks substantially better than this. You can see an annualized return down 40%. That's per year. Again, nominally, we're from 25,000 down to below 5,000 as of today. So it's down over 80% as a short position. Maximum drawdown 91%. This is obviously quite diabolical. Now, what we can do is we can actually look, because remember, like I said, the constant position of a short vol position where you just do it blindly and you just hold short vol, that probably never worked. I mean, I'm not suggesting that that was somehow a strategy in the past. It certainly wasn't. Short vol is always going to have that very convex punishment against you. You know, it's not an equal risk reward profile across the board. So holding a constant short position is probably a terrible idea. And if you just did it blindly, certainly it would lose money and you'd end up owing the bank a whole bunch of money if you were actually using undefined risk trading. But the point for what we do, being tactical, managing those entries and exits, is you just want to eliminate as many of those bad days as you can. We can't eliminate all of them, but what we can try to do is try to whittle through some of these and make sure that the ones that really jump out at us, that we can actually eliminate those. And the first thing that you can do, and I'm sure you've probably heard this before, which is why it's the first one I'm going to do, is you could probably make a pretty hard rule. Don't short volatility when the VIX futures are in backwardation. All right, this is not a recommendation. I'm not licensed to give you any direct personalized investment advice. But as a general layer to start with, shorting volatility during backwardation is probably asking for trouble, because backwardation during market declines can last for several months. And if you're in the habit of shorting vol during that, these are just one-day spikes. But the real danger is holding short vol when it's going down for 2 months straight. And one of the very quick and easy ways you can avoid that is to just not short vol during backwardation. Now, just a very quick review here. This is the VIX Futures term structure, everybody's favorite website, VIXCentral.com. Now, what backwardation essentially is, we'll start with contango first. I'm sure you've heard these terms. This is the second month VIX future, and this is the front month VIX future. All of these are a different month going further out in time. All contango means, and it's certainly not a great indicator. I'm not suggesting that this is some game-changing indicator. I'm just saying that as a baseline signal, when this number is higher than this one, that is called contango. And that is signaling a market that is somewhat normal when that is the condition. And the basic reason for that is more bad things can happen in the future than they can in short periods of time. So if the market is under completely normal market conditions, we would expect that this future expiring in 18 days, less bad things can happen with this one. It's far more predictable to be with this one. This future expiring in 109 days, a lot of bad things can happen in 109 days. Now, obviously in today's market, plenty of bad things can happen in 18 as well, but certainly 109 days out, traders need to be compensated for taking on that additional unknown risk. And that's why, under a stable, normal market, the VIX futures will align themselves in what we call contango. Backwardation would be the opposite of this, where all of these further out futures are actually lower than the front month future. That is a market that is in turmoil. It is a market that is definitely has some elevated levels of fear. And whenever we see market sell-offs, that's what you will see. You'll see these VIX futures. This will actually invert, and it will look like a downward sloping line. That's what backwardation is. Now, again, as a very simple overlay to this, if you just didn't short vol during backwardation, then what you're going to end up with is you're going to eliminate half of the positions. So pretty decent. Now you're down to a list of 15. You can see all of the ones in red. We've covered those up. All of the entries here that are still in white, that's when we have significant VIX futures contango. So if you're left with a list of 15, that's pretty decent. This is a list of 15 of the largest VXX spikes since 2004. All right, that's a very long history, 18 years essentially, and you're left with 15 instances where you would have got caught holding those short vol positions. And you can see some of them pretty substantial contango. They were basically out of nowhere. Now, one thing that I can do, because I have, I don't know how to say it, many higher level metrics. Remember, the VIX futures is not the end all be all signal. It's just what is most commonly quoted, contango backwardation. But it's a fairly simplistic metric. It's a very simple filter. I go many steps further, of course. Like I said, I have the volatility barometer that I have designed that is basically a comprehensive view of the entire volatility space. It's VIX futures, the VIX, the VVIX, the cash VIX term structure, all your VIX 9D, your VIX 3M, 6M, all of this is actually combined into a single value for my volatility barometer. So if we were to apply my volatility barometer and we are not going to short vol during backwardation, and we're not going to short vol when the volatility barometer is over 60%, which is signaling danger, then what we have is this. Now we're down to 8, right? And you can see some of these entries. This first one that was eliminated, 5.64% contango. A lot of short vol traders would have been in the trade that day, right? They would have looked at the futures. They would have thought, no reason not to be short here. It's in contango. Everybody said that's a great time to short vol. But my volatility barometer was, of course, screaming warning signs. So that would be one we could eliminate. And several of the other ones, even though there is significant contango, 5% here, we can eliminate that one. There's 9 here. This is the Asian currency crisis in 2007. My barometer doesn't go back that far in its current form. But if I reduce the number of metrics and I can get a look at it, it would certainly have been over 70% as well. So we would eliminate those. And now we're down to 8. So 8 really terrible gut kick days in a span of 18 years, it's manageable. It's certainly not fun, but if you get that number as low as you possibly can, you're still able to participate in the short vol trade. But remember, what we're trying to avoid, of course, is just being too blind with our trading. We're trying to avoid this. If you trade too often and too active, this is what happens to you. It doesn't matter what your underlying you're using, whether you're using long XIV in the past, short VXX, short UVXY, UVXY call options, and you're repeatedly selling them. You're buying VXX put options as stock replacement, like I'm very fond of doing. Doesn't matter what you're representing. If you trade too often and too active, this is what it's going to look like. There is no free money in these markets. There's no possible way that somebody can just say, I'm just going to do a constantly rolling short vol position, and that's somehow going to make money long term. It's absolutely not. That's not how short vol works. What ends up happening is you end up with a whole bunch of easy wins. Several months maybe go by and nothing eventful happens, and you make a nice little profit. And then, of course, 1 or 2 days comes along, it hits you out of nowhere, and then you end up with pretty much disaster. So again, the goal here is to take a list, knowing that we're going to be hit with some of these, knowing that, of course, we have to allocate capital in order to make money. You cannot make a profit. You cannot invest if you're not going to be subject to occasionally getting something out of nowhere. So if we look at these numbers, for the most recent ones. And this is why I said at the start of the show, there's nothing broken with your strategy if you happen to get beat up on January 27th and February 25th. I personally don't see those as mistakes. If you were short vol and you got hammered on those days, as I did, full disclosure, I felt the entire brunt of both of those. I don't think those are big mistakes, because if you look for the first one, January 27th, 7.15% contango, that's actually higher than the long-term average. That's higher than the long-term median. Long-term median is about 6.85. That's actually slightly above average. My volatility barometer was dead on average. So while this isn't the best signal that we've ever had to short vol, it's certainly not a warning sign. I don't see any reason why a person would not have been short vol the day before this and just let their position go through. And the same thing for the one that hit us yesterday. Again, I got hit with both of these, so I'm not trying to sound like it's an excuse. It's a reason, right? Big difference there. I'm never the type to make excuses. I face it head on and I just move forward. But anyway, look at the metrics for heading into yesterday. Contango at 12.58%. Obviously a fairly normal VIX futures market. Nothing out of the ordinary there. Our volatility barometer was actually 41%, which is low. That's in the kill zone where you definitely would want to be short vol during those periods. If I personally, maybe I'll write this down on a list or something and do a little quick test for you in a future stream. But if you shorted vol anytime this barometer is less than 50%, you'd be very happy with the results. So when we look at a day where we've got the VIX futures that's, completely normal, volatility barometer totally normal, that's why I said pretty much all can be forgiven if you have had a very bad stretch here where you got hammered in January 27th and then you thought everything was going well, you were chipping away at that drawdown, and then you got hit again. That's exactly how I feel right now. I feel like, we got crushed in January, had a pretty good 2020, but crushed right away in January 27th. And then actually February was going pretty well. And then of course, gut kick out of nowhere. 12.58% contango the day before, volatility barometer at 40%. What are you going to do? I mean, I think the test of a trade, whether it's the right position or the wrong position, is after you learn your lesson. And unfortunately in investing, oftentimes lessons are learned through taking financial losses. After you learn the lesson, you absorb the impact of it, you go through your past spreadsheets and you analyze what went wrong. The test is, would you do it again? If that market presented itself again, would you do it again? I can tell you 100% certain I will be short vol if that market materializes again. If all the metrics are in the same place that they were that day, well, that's my system. I'm going to be short vol that day, and I'm just going to hope that we don't get hit with, one of those stupid out of nowhere up 16% VXX days. What are you going to do? But also, like I said, and I would encourage everybody else to do, I also have more metrics that I overlay, not only the VIX futures. That's a very basic signal, a very entry-level filter, and then the volatility barometer. But I actually go further than that as well. So I didn't get hit with all 8 of them. In the past, for my volatility strategy, 4 of them jumped out of nowhere. Really no reason why we weren't short vol in those, and got hit 4 times. The really painful part, and this is what my community is feeling. This is a public live stream, so you're probably not in the community. But what we're feeling is 2 of the 4 days that we got gut kicked, and I've been trading for over 10 years with these vol products, navigating the market really well, managing risk, and kept drawdowns to an absolute minimum for the entire time. Twice in the same month, 2 of the 4 biggest hits that I've ever taken in my portfolio are separated by 4 weeks. So that's really why this feels a lot worse than it usually does. I've been hit before back-to-back days, but this does feel worse. And I'm sure that a lot of you, I can see the comments over here, I think quite a few of you are feeling the same thing. So if you're going to invest, if you're going to allocate capital, you're going to have to take losses along the way. The point is to don't do this. Don't just blindly short vol, because there will be extended periods of time, multiple years in a row, regardless of what people you follow on social media say, how easy the trade is. Remember, they're just avatars on a social media website. They're not actually in the industry or managing capital. They're not posting performance. They're just an avatar on Twitter. No matter how easy they say this trade is, it is not. Short volatility is not free money. It had a golden era from about 2011 after the European debt crisis to, we could make a case right through to the February 2018, sort of the golden era of short vol. But for the most part, you can expect multiple years where the trade will be broken. And that's what we see here. But certainly from about 2007 up until Lehman crashed in September 2008, that entire 18-month period, even though that's not considered the financial crisis, absolutely the short vol trade would have been broken for those 18 months as well. It would have been a very difficult time to trade. The last 4 years of the dot-com bubble, for example, we've got the VIX index, which, you might have think, well, the dot-com bubble is raging higher. Everything's going up. Stocks it's just all perfect. Well, unfortunately, that's not really the case. You can see here, this is the last 3 years of the dot-com bubble. The VIX was well over 20 that entire 3-year period. Now, yes, the S&P was raging higher, but volatility would have been very unpredictable in those moments. You can see averaging anywhere from about 22 to over 25. That's during the best times of the stock market. So this idea that short vol is somehow an easy trade, that's what avatars on Twitter say. For anybody who actually trades real capital, and certainly for people who are responsible for showing real results, we know how difficult this is. And we know that we're going to get hit. We got to take that list of 30 of the worst days or 50 of the worst days, and you have to use your knowledge and your experience, tactically rotating in and out, trying to find the most advantageous times to be short and get out of the market in all of the times where there's red flags, because that's the only way to survive the short vol trade. You have to find a way, and I have my way. I've been doing this a long time. Of course, I have my own metrics. You have to find ways to start to whittle away, adding filters to that list and getting out of that short VXX position that long-term is a loser. You got to get out of that. So, like I said, the very first entry-level signal you could layer on, try to understand contango backwardation, the VIX futures market, the VIX futures expiration cycles, all of those things. Start with that as your entry point. You might be new to the volatility trade, and I appreciate you coming to my streams. I'd start with that. I've got a lot of information, but it's one of those things that so do a lot of other people. It's a very common knowledge type of metric, so you're going to get good information on it. And then from there, you can start building your own set of filters. And you can start thinking, well, I've noticed, and spreadsheets and data mining back it up, that the short vol trade doesn't do very well when X, Y, and Z metrics are in place. Well, maybe I'll move to cash during those ones. And I've noticed that it does exceptionally well when A, B, and C metrics are in place. Well, you definitely want to be short vol during those. And through trial and error, and unfortunately, through taking trading losses, you will get your list down to something manageable. And you'll be able to avoid, hopefully, at least some of these terrible days. Because take my word for it, as somebody who felt both of these highlighted in blue, it's not fun. And it sets you back several weeks, several months. It's really not fun at all. But the goal, of course, is to reduce risk and to just do the best you can with a very difficult trade. Thank you so much for watching the video. So don't forget to subscribe to the channel and go check out my website right here. There's tons of articles and videos on there, as well as a free trial to join the VTS investing community. What have you got to lose? Come see how I personally navigate these unruly markets. See you next time.